But here's a topic that I'm much more equipped to talk about. But I wanted to do a continuation of our series about measuring risk. This is going to be a very options focused part of the series. And for people who are familiar with trading options, this is hopefully going to be a nice little refresher on some of the primary risk measures that it might be good to use to comfortably trade options. So yes, just to introduce a little bit, recap so far. So far, we've covered historical volatility, beta, CVaR, and most recently implied volatility. And in this segment, we're going to continue our discussion around forward-looking risk metrics. And in this segment, we're specifically going to cover basic risk measures for options. So again, these are going to be more option specific. Certainly not going to apply to everybody, but and if you do already trade options, this should hopefully be a nice little refresher around some risk measures and sort of where they come from. Just to recap the outline of like what this whole series is trying to do, we want to look at risk from risk is a multi-dimensional concept, and so there's really two different ways that we can look at it, which are historical metrics and forward-looking metrics. The historical ones, which are based on previous price data, and obviously those come with several caveats. And then forward-looking metrics, which we've already talked about some. So we already talked about implied volatility, distribution statistics from simulated data. I wanted to talk in much more depth about how to actually simulate stock prices and how to actually do financial simulations. That's a topic that I find very interesting. So we're actually going to end with that. And for now, we're going to focus on more option-specific risk metrics, which would be the Greeks. Today, I wanted to focus on beta, weighted delta, theta, and gamma. And then I also wanted to focus on buying power reduction, which gives you a limited but insightful view on risk, specifically worst-case loss is what it tries to estimate. Okay, so let's get into it a little bit. If you have any questions, feel free to shout those out, throw them over in chat. But to just recap a little bit what the Greeks are, if they're basically a set of risk measures, and those are derived from the Black-Scholes model. And what they try to do is sort of quantify the sensitivity of an options price with respect to changes in some variable. And we're going to look at a couple different ones. So like, how does the P&L of an option really change depending on how another variable changes? And how is that expected in time? This is a forward-looking metric, similar to implied volatility. It's trying to estimate the expected behavior in the options price given some specific outcome in the future. So it does give you a sort of granular insight into how option P&Ls are expected to change relative to some variable. But obviously, markets are much more messy than that, much more complex. And usually we don't see just one variable changing without another variable changing. But it still can give you sort of like metrics that you can really build a trading framework around, and they're very powerful tools. So the first one, delta. We talk a lot about delta. We see delta an awful lot. And a little bit of a refresher back to school. It's the expected range of expected change in an options price given a $1 increase in the price of the underlying. And then formula is the sort of mathematical representation of that. So really, we're looking at the change in an option price, which is going to be represented as V here. So it's either going to be a call or a put. The generalized variable is V. And we're going to say relative to small changes in the stock price S, what is the expected change in the option price? That is what delta measures. So it really measures the degree of directional risk of a position in terms of underlying shares. So this is something called share equivalency. I think it's one of the easier ways to sort of like understand intuitively what delta is measuring. But for example, what that means is that if you have an option with a delta of 40, so an option with 40 delta has about the same risk as 40 shares of underlying stock, right? And then the negative delta would give you the inverse of that. So it really gives you an estimate. This is how I like to think about it, at least. It gives you an estimate for how much risk or how much directional exposure there is for a specific option contract relative to the number of shares that you would need to trade in order to get that equivalent amount of risk. So that's, again, a concept called share equivalency. Delta is obviously very important when it comes to actually constructing a trade because that really defines how much directional exposure to the underlying price that you have. And because you can control what the delta of a contract is, it gives you a lot more control over the directional exposure of a trade compared to just doing long or short stock. You get a little bit more flexibility in terms of how much directional exposure that you get. The way that you read it, it ranges from -1 to 1, and the sign depends on the type of position. So long stock has delta of 1. It moves 1 for 1 with the stock, right? And then long calls and short puts have deltas that are between 1 and so we have our positive deltas for long calls and short puts, and then for short calls and long puts we have negative deltas with a maximum of 1 for that magnitude. And so delta is obviously going to be very important for constructing certain positions, but it's also going to be important for actually building portfolios and combinations of strategies, because delta neutrality, here we go, comes with several benefits. You can change your risk profile such that you have the potential to profit or lose, right? You have risk without having directional exposure. So that's something called delta neutrality, which you can actually achieve by combining options or long short stock to get a certain level of delta that's flat, which is a really interesting strategic capacity that you can't necessarily get with other types of instruments. So to just recap how we use delta. So delta is additive across the option legs with the same underlying. So if I have a bunch of different Apple contracts, a bunch of different strikes, a bunch of different expiration cycles, I can add all those together and get some kind of delta that shows my directional exposure to that underlying, to Apple in this example. But it's not additive across options with different underlyings. So if I have Apple and Tesla, obviously a $1 move in Tesla is going to impact the options pretty differently compared to a $1 move in Apple. So because the delta, the units are not the same, or rather the underlying is not the same, I can't add those together. But there's a little trick that you can do to make that a little bit more feasible, which is beta weighting it. So we've talked about beta. We actually talked about it previously in that series, or in this series. But effectively what you can do is you can beta weight the deltas of an option such that the delta measures the change in the option's price relative to some benchmark rather than the underlying itself, right? And we use beta weighting as a way to describe that. So basically, if we look at the beta weighted delta of Tesla options and Apple options, both of those beta weighted deltas tell us the expected change in those options relative to a $1 move in SPY, for example, if that is our benchmark. Because we are normalizing these deltas with respect to some standard underlying, and we're sort of like normalizing those units basically, now we can look at the beta weighted delta of an entire portfolio and gauge our overall directional exposure to some benchmark, which is usually like the market. So usually the S&P. So that's sort of a way to get around this limitation with delta so that we can look at overall portfolio delta and overall directional exposure. So that's when we would use beta weighted delta versus regular delta. Let's get to everybody's favorite, theta, or at least our favorite. So theta, right? This is another way to say time decay, basically. It measures the expected change in an option's extrinsic value per day. And then the magnitude of theta is generally highest for at the money options. So we're looking at like basically how much value does this option lose per day, or how much is it expected to lose per day. So by selling options, this is sort of a measure of like how much expected profit you can, maybe assess over a certain amount of time or expect over a certain amount of time. And then for long options traders, this is more of an estimate for how much you can expect it to lose over time. So depending on which side you're on, whether you're buying options or selling options, this will give you obviously different measures of risk and different levels of benefit. And so the mathematical representation is given over here, but basically we're looking at the change in an options price with respect to small changes in time is the variable that we're looking. So this is specifically the sensitivity of the options price relative to changes in time. And then highest for at the money options, the sign of theta is also going to depend on the type of contract. And again, depending on which side of the contract you're on, you are either expecting to profit from theta or lose money from theta. Right. And then theta is also additive across positions in a portfolio just because the units are the same. So they're all in dollars per day. So you can actually look at portfolio theta and gauge how much overall exposure there is without having to modify the variable at all in order to actually gauge that variable in your portfolio, which is kind of cool. So that's theta, the short seller's favorite. And then we also have gamma, which is not our favorite. There is an inverse relationship between gamma and theta. So gamma is a second order Greek. It's the expected change in the options delta given a $1 increase in the price of the underlying. And this is called a second order derivative because it is a derivative of a derivative. We're looking at the change in delta given changes in the stock price. And we're looking at the sensitivity of the Greek with respect to the underlying variable. And that's a second order derivative, which is why we call it a second order Greek. And this is also, so there's a trade-off between gamma and theta. The magnitude of gamma is also generally highest for at the money options. And when we say there's a trade-off, So positions with higher gamma tend to also have higher theta. So if you're selling, so for instance, selling an option and you have your profit potential dictated by theta, the risk comes from gamma, or one of the risk factors comes from gamma. So the higher the theta, the higher the gamma. The more potential profit there is to collect from selling that position, the more variability and sensitivity there is in the delta. So the even more sensitive to that directional risk, there even higher sensitivity to directional risk there is. So that's when we say when there's a trade-off. Generally, when you have more of one, you have more of the other. And so even though like theta is something that can be attractive to short premium sellers, you have to be very mindful of the gamma, because that means there's just more sensitivity in the delta that comes with that. So when we say the trade-off, this is a just general overview synopsis of what that means. And gamma is very importantly not additive across all portfolio options for the same reason as delta. So because delta is not standardized across underlyings, right? Because a $1 change in one underlying is going to mean something very different to the options compared to a $1 change in another underlying. Because gamma is based on delta, right? That means that we cannot add them across positions because our units don't really line up across underlyings. But you cannot reliably beta weight gamma, because at that point the errors become too big. They kind of compound as you use these higher and higher order Greeks. So you cannot beta weight gamma the same way that you can beta weight delta, unfortunately. But because there's this trade-off between gamma and theta, there's a little bit of a trick, which is that you can kind of look at something called the theta ratio. So the amount of theta divided by the net lick of the portfolio, it can kind of give you an idea of how much gamma exposure there is. Because, right, the higher the gamma, or the higher the theta, the higher the gamma, right? So even though you can't measure the gamma of a portfolio reliably, at all, we can still use theta to kind of like assess if there might be too much gamma exposure in a portfolio, if that makes sense. Does that make sense?
Yep.
Very
Yes.
nice. So just to kind of summarize before we kind of quickly hop into BPR, the pros and cons of the Greeks. How should we use these, or how should we expect to use these, and what are the drawbacks? So the pros of the Greeks is that they are forward-looking estimates, and they give you pretty granular risk estimates for options with respect to specific variables. So, right, like for like a stock, for example, like, assessing the different areas of risk might be kind of tricky. There's a bunch of different strategies for doing that. For options, it's a little bit simpler because you have this catalog of risk measures that you can use to sort of assess those different risk factors, which is nice. And because of that, you can use the Greeks to kind of like build portfolio and position management strategies that are a little bit simpler, oddly enough, even though the metrics themselves are a little bit harder to understand. I would argue that makes the position and portfolio management a little bit easier, because you have this, collection of different risk measures that tell you specific areas of sensitivity, which is nice. But the cons is that the Greeks are model dependent. We talked about them being derived from the Black-Scholes model. And so what that means is that when you're in conditions when models tend to break down, such as very short time frames, like 1 DTE, 0 DTE, or if you're in highly volatile market conditions, or if you're dealing with discontinuous price movements, something reports earnings and it has a jump, but that's not continuous. Those are situations when the Black-Scholes model and the assumptions tend to break down, which means the Greeks can also misrepresent risk in those situations. So you need to be careful about when you use them and identify periods when they might be less reliable, I guess, for active trading. Let's get into the last one, buying power reduction. So this is another option specific risk metric. Basically, that's the amount of capital that you need to put on and maintain a trade. So for long options, BPR is just the cost of the contracts. And then for short options, it's either the max loss for a defined risk position, or it's the best case estimate for the max loss for an undefined risk position in the current market conditions. So more specifically, buying power is intended to account for roughly 95% of potential losses for ETF options and about 90% of potential losses for stock options. Because remember that when we're trading certain types of short options, right, if they're undefined risk, the loss is not known. We don't know what the potential loss is. It depends on how the market moves, right? So basically, yes, brokers need to construct some kind of estimate for how much capital should be held throughout the duration of the trade. And if you don't blow past BPR, right, then you get that money back at the end of the trade. But it's really like an amount that's held throughout the duration of the trade to kind of cover the potential losses in case something goes wrong. And that estimate is meant to account for like what we expect the max loss to be in a worst case scenario. And different institutions are going to calculate it differently, but one is for undefined risk options. It's the largest of three possible values, which is the expected loss from a 20% move in the underlying, the expected loss from a 10% strike breach, and then 250 minus the contract price. And that last one is really for cheap options, just so there's some minimum, right, to account for that potential risk. So it's the largest of these possible values is what many institutions estimate as the worst case loss for a type of position that doesn't have a loss that's sort of like known beforehand. So what the pros and cons of using this are, the first is that it's very simple. It's simple. It's pretty easy to understand. It's something that's computed usually by a brokerage institution. And it's a fairly reliable estimate for worst case loss for undefined risk. It also plays a pretty key role in determining position sizes. So a lot of the times buying power is what traders will use to determine if a position size isn't appropriate for a certain account. But the cons are that it really only gives an estimate for worst case loss. And it really neglects important nuances that some of the other risk measures that we talked about do address. So that's, I think, like two the bigger cons. And then the last one is that it is only an estimate. Losses can certainly exceed that estimate, although it is incredibly rare for that to happen. So it gives you a pretty limited representation of risk. In addition to that, we have to remember that it is an estimate. So we can use BPR. It's extremely important for position sizing, but there's limitations in terms of how it can be used. But to just conclude this very long segment, hopefully it was a refresher. We get to get exposed to our Greeks again and get a little bit of an insight into where they come from. But the Greeks, such as delta, theta, and gamma, are a set of risk measures that explain an option's expected change given a change in some other variable. They provide granular risk estimates, but are model dependent and can misrepresent risk in extreme circumstances. BPR is the amount of capital that's required to open and maintain an options trade and provides a reliable estimate of worst case loss for undefined risk positions. But BPR really only focuses on one aspect of risk and cannot really offer much nuance beyond extreme loss and what that estimate kind of looks like. But love to know what you think. Thank you guys, everybody, for listening. Hopefully this is either a nice little refresher or a nice little introduction on some risk measures that are important for options trading. Thank you for watching.